All right, good morning, ladies and gentlemen. Today is March 25th, 2020, and I am back with another weekly edition of the Investing Systems Live Show. And boy, what a wild market we have here. So, today is a very special show because we have some new stuff to show you, and I actually have Jeffrey on the Skype who will be joining us in a minute here. And so, this is going to be really interesting show. So I thought that we would start off by just taking a look at the S&P 500. And man, I mean, there's so much to talk about, but just real quickly, let's look at where we are here. So, we've had this humongous sell off, and then Monday we've got, kind of what looks like a little capitulation pivot low. And then we had a little bit of a reversal, which I think was kind of expected. I mean, really on Monday when the market hit these lows, you could kind of sense the fear and the panic, which is typical of at least a near-term capitulation low, right? I mean, there was people calling for him to close the market and all that type of thing because it was dropping so fast. But like anything, every those of you that have traded or been through these type of bear markets before know that eventually the market gets extremely oversold and then you get some sort of a bounce, but it's a very news driven market right now. And so, hey, are you there, Jeffrey? How you doing this morning?
Doing great, Bill.
Yeah.
Yeah,
This, what were you going
go
to say?
ahead.
Oh, I was going to
No,
say
go ahead.
that, I believe that from top to bottom, we were looking at like about a 37% sell off, which is pretty extraordinary in the fact that it happened so quickly, right?
Yeah, I mean, this sell-off was one for the record books. Uh, you know, the funny thing is, I was basically telling people for quite a while, market's overheated, it's way overvalued, expect a normal technical correction. But oh my goodness, this one was a doozy. But the great thing about this, we needed this kind of market reset for the longest time. So I look at this as a real positive thing.
Yeah, that's absolutely true because if as you recall, like so I have this trend line way up here from, October to, when the market actually started falling, but you remember it was just kind of like a real boring sort of drift up almost every day, and it didn't seem like it was sort of, normal, right? I mean, the market had been going up and up, and so anyway, the whole time that this market was going up, sort of in the fall and into the new year, and that, it just felt like it just didn't, to me anyway. It kind of didn't feel right, but I don't know. It seemed like everyone got just extremely complacent, and it was sort of weird. But anyway, the crazy thing, I want to show you something. I'm going to pull up the monthly chart here, and I know there's a delay in the show, but I drew a trend line on the monthly chart. And the reason I wanted to bring this up is that when I look at the daily charts now, especially on a lot of stocks, they're at lower points than they've been in the past couple of years, and so you almost have to go to the longer time frames to get some really good perspective on where things are. And so I find myself, especially on individual stocks, I find myself flipping over to the weekly chart a lot recently just to sort of, see where a stock is in context to, the longer term. And so, and then a lot of times, I end up over here on the monthly charts just looking at the really big picture because of where so many stocks are right now. So, anyway, this trend line that I've drawn here, I mean, this is a crazy trend line, right? It's between like the two lowest points on the chart. My chart only goes back to 1979, right? And so to me, this seems like sort of, the biggest picture trend line that you could possibly look at, and look where it intersects. Basically, basically, it intersects at like the high of. Can you see that chart on the screen? Are you watching the show, Jeffrey?
Yeah, yeah, I can
Yeah,
see
isn't
it.
that pretty interesting? How, I mean, if I drop the horizontal line on it right here at the highs. Oh, and by the way, I've got this on log scale because it seems like, when you look at a super long time frame like this, log scale seems to make sense. But Anyway, the weird thing, and I'm not saying it's going to drop down here, right? But if there were no numbers on this chart, and there was, you didn't know what it was, there was no numbers on this chart, and you didn't really recognize it or whatever, it would seem like, this sort of area right here, right, where this uptrend line and this horizontal line I just drew kind of converge, would almost be like a natural, sort of humongous point of support, doesn't it? And the scary thing about that is that that's actually down there at, 1500 and something. So
Well, guess what? I mean, there's technicians saying that's where we're going. So
I've actually
that's
seen some other people say that too. I think 1700 seems to be a popular, like maybe if I zoom in here or something, 1700 something seems to be another popular area of support.
we'll put a support line right over the highs of that last the first pivot high after the breakout above your current line that you've got. And that's kind of where we're heading towards. Yeah, right there. That's where we're heading towards now. Uh,
Yeah.
so that's kind of we ran down and so that's kind of probably why we're seeing a bounce at this point, right? Because we've gotten all the way down above that
Yeah.
level of
Check this out on the Dow. I drew. This is really interesting too. So I pull up the Dow and I drew like a Fibonacci from the 2009 bottom, right? Remember, the bear market of 2008 or whatever, and then the very low there where it was 666. Or well, I'm sorry because that's the S&P. So anyway, though, from the 2009 low, which it was in March, all the way to the recent high, look at how the Dow came down and like basically retraced and found a lot of support right there at 50%. And so it came down and it gave back like half of, this whole decade long bull market. And then look
hmm
where it is now. It's like sitting, as we speak right here, it's sitting back at the 38.2. So, and I've never been like real big on Fibonacci or anything like that. Some people swear by it, but to me it's just another thing that's kind of interesting to look at, but I don't really base anything off of it, but I just find it to be, an interesting coincidence that we retraced 50% of that at the lows. So that's
well, sure. Fibonacci works like moving averages work. There's a giant feedback mechanism, and a lot of times Fibonacci's work because everybody's looking at the Fibonacci levels. But no, you're right. I mean, that's a huge haircut for the markets, huge reset. But again, from a swing trading standpoint, this is like a breath of fresh air. This is a great reset for us. This really will get things, stir the pot and get things back in motion now for us. Because we just had we had an artificially overinflated market that, it had a lot of difficulty trying to make new highs and hang on to them, and the ranges were, you know, the ranges and the cycles got pretty boring, and so this is a great this is like a Christmas present basically for swing traders. Now, if you were a buy and hold investor and you didn't use any stops because you're in it for the long term, oh boy, you're in it for the long term now. So,
Yeah, I agree. I think that the as bad as as bad as everything that's caused this. I mean, that's sort of the wild card on how this is going to play out. But I agree that this is going to present a lot of opportunities going forward. When things eventually will begin to normalize, and in this type of a sell off, the baby always gets thrown out with the bathwater. That's where the old saying comes from. And so there's going to be a ton of opportunities to probably, buy certain stocks that are going to never look back, right? Which is kind of interesting. And that kind of segues into what we're going to talk about here in a few minutes is most of you have probably seen that note on the home page when you logged in. And so, in a few minutes here, we're going to talk about a brand new thing that we've introduced to the system, which is the recovery stocks, which is super cool. And so, we're going to unveil it here in a few minutes. But real quick, before we do that, we have 4 open trades, and I just wanted to take a quick look at those. So I'll just start from the top with this EHTH that just triggered in here, and let me pull that up. The EHTH. Pull that up here. We had a really good trade in this back in February, and it got closed ahead of earnings. Right. Let me go to my normal chart here. There we go. I kind of like the open, high, low, close. Look at this. I don't know if you remember this, probably do, but we had this really nice trade in early February, and then stock ran up, closed it ahead of earnings, and look what happened when they released earnings, right? I mean, that's what obviously why we've always said that we don't hold these stocks through earnings because they make crazy moves. But anyway, so this one just triggered in, and let me pull it up on my other screen here. So I have this marked up. Let's see, 324. And so let me ask you a question here, Jeffrey. The past couple of weeks, actually maybe like since the sell-off started, I've been suggesting that people be maybe um, a little bit more cautious with their entries. Under normal circumstances, when the ranges were real small, you could basically just when a stock triggered in the next morning, it's trading above the trigger. You just jump in and don't sweat the small stuff. But lately, I've been saying there's a couple different ways to play it, and I know that you've always mentioned that taking a half position or a half position and then waiting to get filled on the other half at the actual trigger price. I've been suggesting maybe just setting a limit at the trigger price and seeing if you get filled. And so there's different ways to play this, but you want to talk about that because with these kind of ranges, I think it makes sense to be a little more tactical with the entries.
Yeah, exactly. One of the things, because trading is a process, and because we can never truly predict what the market's going to do, we just basically have to continue trading through different market conditions. Now, obviously, if they shut the market down and things are haywire, you can take a couple day break. Not saying you have to trade every day, but uh, the thing you want to do though is lighten up, because these ranges have just been absolutely humongous. So your stops are going to be bigger. So my advice is just continue to trade through it, but maybe trade a little bit less and trade lighter positions. Go in half, and there's nothing wrong with hedging around a little bit. Today's a good example of how the market just sucked in a whole ton of people at the open today and then thrashed them.
Hmm.
If you take a look at the the open today, uh, so we're in a very choppy, wild, turbulent type of market, and we can get wild swings to the upside. We can get wild swings to the downside. So again, continue trading through this. Don't be shy or scared, but just lighten the load a little bit. And so, uh, because we never know when things are just going to go ballistic and take off. And if you're sitting on the sidelines, you'll be looking back, going, "Oh man, it's all the setups were there. I just was too scared to take them." Right? I mean, that's a feeling that you can get quite a bit if you just stop pulling the trigger. So, yeah, only thing you can do in this market is trade a lot lighter, and don't overtrade, don't push these market conditions.
Yeah, here's the next open trade, TDOC, and I mean, yeah, when I look at my Thinkorswim screen, I'm like, oh, the stock's down 5% today, right? And then I look at this chart, and I mean, just absolutely amazing. This one, interestingly enough, when it triggered over here on, I guess it was Friday, it actually had a huge move higher and then faded down and like literally closed just barely over the trigger there. So the close that day was 141.74. The trigger was 141, but look at the move the next day. And so, this is a pretty good example of, like you say, why you want to continue to trade because you never know, when a stock certain stocks in this market are making extraordinary moves, and this thing took off and came up here and actually tagged the target. right? And so even though, it's down 5% today, it's just an extremely volatile stock. This thing was up double digits on Monday, right? And then had that big gap up yesterday. And so, here's another thing, probably a good example of, when you have a gain, if you bought this stock anywhere in the neighborhood of, anywhere in the neighborhood between the trigger and this open, or anywhere around here, you get that big up day and you see a huge gap the following day, regardless of, the target or anything else. It makes sense to take profits quickly, right? Take some off the table when they're there, because we're going to see a lot of up and down price action. And so,
Yeah, and especially on an obvious play like that, um, that's that's one of our quickie price volume type crescendos where you had the long range day right before. You see how the market opened towards the low, and then you had the big long range up day, the close up towards the high, and then the gap up the next day. I mean, that is an obvious. You could take profits on half at the open, or sell the whole thing, right? Because that is a technical exit. I think we got that covered somewhere, don't
yeah,
we?
we do. We
Yeah,
actually, I think we have a video about the price volume crescendo,
yeah.
and we talked
So
about that.
that's a pretty obvious one right there. Again, you didn't have to take everything off, but if you're doing a thing where you take half off the table, that's an obvious one. Obvious setup to do that on.
Yeah, another interesting thing about the way that the system is programmed is how quickly these stops are moving up in this sort of environment. Like, this one started off, and this trade's only, 3 days old, right? And so the initial stop started off like sort of way down here, below the some of the ranges, and then literally overnight, within a day, that stop's already up here. And so my guess is that, it come up pretty close to break even. This is the type of stock that, it looks kind of weak here today, but this thing could just bust out of the, it could bust a move higher tomorrow. So you just don't know. But anyway, let's go to the next one here, because there's only four of these open trades, and this is the third one. I'm going to blaze through here so we can get to the good stuff. This one's looking pretty good too. Now, you had a very similar sort of move a couple of days ago on this, right? And this is just, a great example of how crazy this market is. Look at the ranges on this thing. And so, the trigger here was 119.90, and, opened a little bit higher than that on, let's see, it was just another one. Yeah, Friday. Well, actually, hang on. 319. Yeah, and so Friday would have been the day that this one triggered in. And then the following day, you had a huge gap up and that big move right there. And, it's still in play, but, if you followed the system. Now, here's a case where if you put a limit order in at the trigger price, you would not have gotten filled, and so that's why it's not a bad idea. Would you say that in a case like this, or kind of when you see these stocks gapping like this, it's not a bad idea to go in half a position at the open and then try and get the other half at the trigger price?
Yeah, and nowadays with the commissions as low as they are, that's perfectly fine. I mean, the old days when commissions were really high, you would have said, "Well, I don't want to have to pay double commissions, so
But
it's not
commissions are
worth."
zero now. I mean,
Well,
literally
yeah,
every brokerage has zero
yep.
commissions, and so going in half positions and splitting up your entries and exits is totally no big deal at all.
Yeah, and again, that's the way you hedge around a volatile market like this is, um, you know, it's one of those damned if we do, damned if we don't type of things. We can miss a really good opportunity completely, or we can get in at a bad level. It's all about not wanting to miss the potential move. So in this case, yeah, you could have said, okay, the stock is triggering. I'm already on half positions for this volatile market. Now I'm going to go half on the entry. So you basically would be taking a quarter position, and then just uh, see if the stock can go back down and give you a better fill lower, and then you have a better average share price. Uh, you know, one of the things to keep in mind is not to focus too much on every individual trade, because what really matters in the long term is how things average out, how they pencil out over the series. So going in for a while and changing your position sizes around a little bit is fine, because it's just you're going to be looking at the averages down the road anyway. It's all about just trying to get money in the markets to work, right? And so yeah, excellent point. Keep it light. Keep take your stops, and but don't get gun shy. Just trade smaller sizes.
Here's another case where the trailing stop, which I just marked on here, is this one's come up really pretty close to the trigger price here. So these trailing stops on these type of stocks are moving quick. And by the way, what's interesting about this is these stocks that we're looking at here that are triggering. These are these basically the four stocks here, are the ones that everybody's been sort of talking about lately, because this Zoom video is what everybody's using to teleconference, right? They're like at the sort of the cutting edge of teleconferencing, working from home, and people being able to do video and all that in companies. And so and the one we looked at, the eHealth or whatever, is or the Teledoc, is like video conferencing with your doctor. So it's just kind of interesting that I mean, there's not a whole lot of stocks that have really been participating in the rally. But and here's the last one, Gilead, which is also another one that's kind of been in the news, because I believe that pharmaceutical drug biotechnology company. This is kind of a strange one, because the volatility here has just been crazy, right? And so I've seen there's a couple of closed trades that got knocked out on some similar volatility, where it basically ripped higher and had a big sell off and then went higher again. So I mean, it's just to be expected. But this one's really kind of interesting. Let me see if the stop on this, yeah, this initial stop is still, this one hasn't moved yet. And I guess that's sort of a function of how quickly, it kind of ran up and then just came right back down. So,
Yeah, our uh, challenge with the initial stop is it's got to go in at a place that's not going to get you're not going to get knocked out by normal volatility, right? And we want the stop to move quickly in our favor. However, the whole idea is to be able to stay in the position for the potential. I mean, there's nothing worse than literally getting stopped out, by a little down move, and then the price continues on and makes a big move in your favor, right? Like you were in that dang position and you got knocked out because your stop was too close. I mean, that happens all the time with day trading and swing trading. So we have a delicate balance that we're trying to do here. So this one here, yeah, it's recognizing that on that one, it's recognizing that it just needs to keep a little bit of a distance, right? In this, you can see how the pinball action we have on this stock. So
sure, sure.
we'll
So,
see how the system tightens it here going forward.
all right. So, without further ado, we might as well get in and talk about the brand new thing we've introduced here. And so, I'll show you how you get to it. Let me see if I can pull this down a little bit here. All right, so here's what I've done is temporarily, and I may change this a little bit, but just temporarily, we've added the new recovery watch list, and basically I just added it at the bottom of the swing trades menu for now. And so if you click on that, you're going to get a brand new page here that is the recovery watch list. And this is Jeffrey and I had a discussion last night on Skype about this, and he kind of walked me through it and explained what was going on here, and super cool. So what you're going to see in here is a list of big brand name companies, well-known companies that just like the name of the the name says, recovery stocks. And so these are the kind of stocks that are probably going to be around for a while, and they're beaten down significantly. And what we're looking for here is to play a long-term price recovery. So you want to give us a little background on this?
Yeah, basically, this list comprises either individual stocks or sectors that can participate in this recovery. And what we're doing is we're making the assumption that everything in the list here not going to go bankrupt. It's not going to suddenly, like like Enron, go down to zero. Uh, it's guaranteed at some point out in the future, these are going to be the stocks that recover when the market's ready to put a bottom in. And the it's all going to be about like the accumulation value buying that kicks back in when the dust settles, right? The big institutions, the hedge funds, they got a lot of money to put to work, and with the much lower valuations on some of these stocks, and especially some of the sectors like oil, for instance. The oil retracement over the remainder of the year could be like the biggest play of the year. I mean, so we haven't seen. The problem is we just haven't seen any stocks for the longest time to be in a recovery list. This is not any kind of a new concept. I came up with this recovery uh, type of a setup and play probably 20 years ago. So this is nothing new. We just haven't had any recoveries to play because the market's been like artificially, overinflated for the longest time, as everybody knows, right? We've been mostly focusing in on momentum stocks, stocks that are cruising higher on strong momentum, and they just keep going higher, right? Well, right now we have a situation where we've got a big list of stocks, different sectors that are really beaten down, and they're oversold at this point, right?
I notice you have all the market ETFs in here too. You have the Nasdaq, the S&P, the Russell, and the where did it go? The Dow, the DIA. There it is.
Yeah, I put those in there because those are viable things that you can take positions in. And I put them all in there just, if somebody wants to do the Russell or someone wants the Nasdaq, you've got the symbols. You can see the QQQ is actually uh, triggering as of yesterday. And so we'll talk a little bit about how the different ways we can play this list. But the main thing here is to just make the assumption that the majority of these are going to make some attempt to recover to some levels, right? Um, what we're going to end up, if we took this entire list and we looked at it a year from now, we're going to see like a spectrum of stocks that and stocks and symbols that ended up with like a super strong recovery. They go all the way back up to their you know previous highs, and they get climb right back up into bed, and they maybe continue the uptrend over time. And then we're going to see the other end of the spectrum where we get like kind of initial bounces, but there isn't a huge recovery, but there's still a recovery. So the point is that this list represents a list of of trading vehicles. You almost can't go wrong with these making a recovery over the remainder of the year. Now, the trick part is, how do you know when to initiate your positions, and then also how do you do money management? Because it's not as simple as we know exactly where the bottom is and everything. We're going to see some of these will have nice, clean reversals, right? They turn on a dime and this is it. This was the low that, like you mentioned earlier, this is maybe the low that we're going to see in them forever, right? And others, you're going to see a lot of kicking and false starts and choppiness around the bottoms, right? We could see like several days or several weeks of chop action before things pick up. So we'll get in, we'll talk about like actually how you play these. You want to take a look at maybe a couple of them?
Yeah, sure. Let's. I mean,
Take a look at like let's take a look at some of the ones that are like really beaten down.
all right.
What's a good one in there?
Well, let's see. I noticed. We got Starbucks. Let's look at that real quick. Starbucks. Yeah, there you go. I mean, pretty much most of them are beaten down, but yeah, I mean, Starbucks is going to be around, regardless down the road. So it's kind of kind of interesting. It sold down a little bit and then took the big sort of plunge there. And basically you got a stock here that's lost half of its value, and it's going to be around once this crisis passes, right? So
Let's do a let's mark this chart up. This is one of the ones that's already triggered. This triggered yesterday. So let's mark this up a little bit. The stop is down there. What was that? What, 50? Below 54 there, I think. 50.
53.90,
Yeah,
which
so put a line.
I can just put this right at 53.90. I'll turn it red. So there we go. All right, so that looks like, yeah, the low, around the low from a couple of days ago.
All right. And so um, the trigger, it actually triggered yesterday, right? Now, again, remember this first bounce that we get, it could be very choppy, right? And we're already seeing that, like, we had a strong up move yesterday. We're getting a big downdraft today off the open. So we could see things claying around for quite a while in the beginning before things start the recovery process. So the first thing to keep in mind is um, doesn't guarantee a cakewalk, right? This is not like, I mean, it could be. I mean, we could see these stocks trigger, and you just take the first position, and that's the one that works, right? Could very well see that. So the first thing is uh, don't treat any of these as betting the farm on the levels. Let's say that in the next 3 weeks, the market takes another big winger lower, and everything we are looking at now goes and makes new lows. Well, they're going to, these symbols and these entities are still going to recover, but they just didn't, they're not starting the recovery on the first try, basically, right? So we'll talk about different ways to play off this list. Now, what I wanted to do here and what Bill's doing is marking up this chart, and we're seeing, where the stop is supposed to go, and also where the recovery targets are. This is on Starbucks.
Yeah, we can take a look at a few other ones too. I just wanted to. I just randomly picked this because it was the first individual stock on the list. So
Yeah. Let me just make one other mention about this. This is a good example. Now you can see that um, the 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 stock went on the list yesterday. So that's that green up bar, one bar back, right? And then we had the gap up this morning. The market's kind of gapped up, and we're fading back on a lot of stuff. And so the question is, well, how do I know where to take the entries? Um, what you want to do on these recovery plays is, we're not going to have like one level like with the swing trading, where that's like your trigger level. There's a couple different ways you can do this. One is you can just buy the stock at the open the following day after the trigger, right? Some days you're going to end up with some entries, you're going to end up with a gap up like today. You see that? And so
mhm.
you're maybe not getting a great price. And other days you'll have the stock might gap a little bit lower, and then you can just take the entry a little bit lower at the open. So over the series, those will average out. You'll have some that give you a crappy entry and some that give you a better entry, and they end up averaging out over the series, right? You follow? And then the other way to do it is to manage your entry a little bit more, where you say, okay, um, I'm only going to take the entry if it can get above the high of the trigger day, right? So in other words, let's say that on this example of Starbucks, uh, the stock had opened lower than yesterday's close.
Mhm.
You could be watching today's high as a trigger to get in, right? Or let's say at any point the stock pulls back. Let's say over the next several days that stock pulls back, and pulls all the way back to 57, right? You could take an entry down there at 57. You're still above the stop level. So my point is it's you can take entries anywhere between where the stock opens on the day after it triggers to above, just above the stop area.
And that's why there's no specific trigger price in the table here.
Yeah, well, exactly. It's because what we're doing is we're looking for a longer term range. I mean, a longer term recovery. And so, if you the next one we take a look at, we'll mark it up a little differently. But you pick another one if you want to
Okay, well, let's go
take a
with
look.
Microsoft because Microsoft has been. And let me delete what I have on here already. I've got a whole bunch of lines on here. So yeah, Microsoft's a company that's going to be around for the long haul. So let's take a look at this one, and you can talk about this for a minute. And while I mark it up here, so first I'll start with the stop down here at 132.50, which looks like the excuse me, the low of the pattern right here on Microsoft, like right down around this low from Monday.
Yeah. Now, one good thing we got going for us is that if you look, um, Monday's day there was a little, what we call a little spiked low, and it poked down below the lows of all those previous days, right? And then we reversed up. So uh, that's actually a good bullish type of a price bar pattern there. We have a lot of lows that are about the same level, and then one capitulation day pokes down below, but then quickly gets rejected. You see that? So that's actually a good sign. And so on this example, yeah, we know that Microsoft, you can bet Microsoft's probably not going to go bankrupt anytime soon. When the dust settles over the longer term, they're going to be a value play because institutions got to start parking their money somewhere, and so they're going to be accumulating down at these lower valuations, right? That's the general premise of the recovery play. And so we should see stocks make a rebound attempt back into these target levels. Those are the retrace levels. You got the second one on there for Microsoft, the second retrace?
Yeah, I'm getting ready to put it on here.
Yeah. So anyway, the point is that there's different ways we can play this. We'll take a look at this, and then I'll talk about the different ways you can play these positions. All right, and so do me one little favor then, to Bill, put a horizontal resistance line over yesterday's high, the high of yesterday's bar,
All right.
and that'll give us a good feel. And then kind of maybe pull back on that chart. We can get a big picture of what's going on here. So now in this example, what we got here is we have a zone of I guess you'd call it a balance zone, which is what Microsoft is in right now. And you can see how it rejected a new low and it came up, and now we're basically in that balance zone. And that's kind of like we're above like all that big previous congestion level you can see way back, right? So if the market, what you got to do is just think, the bathtub just, you know, they pulled the plug on the bathtub and all the water nearly drained out fast. Now, think the plug's going to go back in the tub and the water is going to gradually fill the tub back up. And so what we're expecting is the prices to uh, fill back up towards those levels. Now, so the way you want to do this is we have a really high probability that we're going to go back to that first target. Okay, you can almost bank on that, right?
Mm-hmm.
And then the second target, that's also a high probability target out in the future. And so one way to do it is, you could take half off at your first target and hold for the second target. And those are going to represent, I haven't worked the numbers or anything, but those are going to represent some pretty nice percent gains just on the recovery. right?
Interesting, yeah. Well, there's I hate to say it, but there's always the potential that, that in this area here ends up being a good buy for this stock, and things start improving and going out into the future, it never looks back. I mean, I've been doing this since stocks traded in fractions, and I remember periods of time where the market would have a sharp sell off and everybody'd get freaked out and scared, and then you'd come back in, a couple of weeks or a couple months later, and you'd think to yourself, man, that was the best buying opportunity. And I mean, and the stock like never looks back from there. I've seen
Yeah,
that many
exactly.
times.
Exactly. And that's why, if you're presented with the technical patterns to be a trader, you have to execute. You have to take the trades. And so, but let's talk a little bit about this. We know, and one of the things I premised with this discussion with is this may not be the bottom. This could be just a false knee-jerk, short-term reaction that sucks a bunch of people in, and then we go much lower, right? I mean, it's totally possible.
Hmm.
We don't know what the news is. Nobody had any clue that the news was going to unfold this dramatically, right? And that's the thing about news. You can't predict it. Um, Things could get totally better all of a sudden. We might, 3 weeks from now, like this, the virus pandemic thing could just kind of dry up and it's no longer even in the news, and it just mysteriously goes away. That's a possibility. Or the whole pandemic thing could get way, way, way worse. I mean, the market pandemonium that we've seen so far could be the tip of the iceberg.
Hmm.
So we don't know how that's going to play out. So what we got to do then, and this is, you can see this bottoming here is very sloppy at this point, right? We're talking about big swings down, big swings up. Nobody knows where we're going. Uh, so keep that in mind, that this is not a one-shot deal. You're not going to be betting the farm on these symbols down at these levels. What you want to do is you want to play these very meticulously with small positions, making the assumption that, hey, we could go lower and things could get real sloppy in the process. We could, and then there's the thing, you buy up here and we run down and get stopped out, and then we turn around and then go back up, right? So, but just in this example here with Microsoft, uh,
All right, I'll go
that
back to it.
yeah, sorry, and then I'll let you go to the next one. I was going to say that, you know, if you're buying anywhere up around where we're at now, 146, 147, uh, uh, the move back up to the first recovery target there, the retrace level, that's about 12%, right? That's not bad. Then a move back up to the second level, that's 22%. So, and this isn't, Microsoft, there's others that are even beaten down further. So the point is that, uh, you know, if you project out the next 3 to 6 months in your mind, then it's not going to be unreasonable to maybe see like Microsoft and some of these other symbols in this list to retrace back into those levels,
Let me
assuming this, yeah.
let me ask you a question here. Okay, so just suppose that we get another leg down in the market and these get stopped out. From what I gather from our conversation last night is that they can re-trigger again in the future, and so that's why you want to take that stop, right? And then there is potential that the stock can actually, it's going to stay on the list, right? Like these stocks that are on the list are going to stay on the list, and we may get multiple attempts at them. And I know that you were going to also discuss sort of a money management strategy that you can use with these. So you want to talk about that a little bit?
Sure, yeah. We'll make the assumption that uh, 50-50 shot that this is not the bottom, right? Just accept that as a possibility. And the reason you don't want to fall in love with any of these stocks, even though that they're on the recovery list, don't fall into the trap of averaging down into these stocks. Okay, so don't do that. Averaging down is a very bad thing to do. Uh, there's almost never a good reason to do it. and I'll talk more about that. The reason you don't want to hang on to these and try to average down is any of these can go much lower than what we see here. We're seeing, Microsoft at what is it, 146. We could see Microsoft at $50 a share. I mean, nobody knows where this is going to, right? And then that would be the heck of a deal, right? The valuation is buy it down at 50. So you don't want to hang on to these because you don't want to incur the big drawdowns. Remember, if one of the problems with averaging down and holding for the long term without a stop is that once you get cut in half, like let's say that you did buy at 147 and Microsoft did, go down to like $70 a share, um, you lost half your money, and so you've incurred a huge drawdown. You've got all that capital tied up too. See, that's what's the bad thing. So the only thing you can do then to free that capital back up is to capitulate way down at that huge loss, right? So you either like put your head in the sand and say, okay, well, I'm a long-term investor now and I'm going to hang on until it goes back, right? See you in 5 years. All that money's tied up, all that capital's tied up. Uh, or you capitulate with a huge loss. So the sensible thing to do is capitulate with the teeny loss, right? Take your stops, and then keep in mind that you are freeing the cash back up, and you're just going to look for another reset down the road. So in other words, Microsoft, let's say that this particular bounce attempt does not hold and we go down and we take those stops out, right? It could take 3 weeks to get down there and do that, or we could do it, 2 days from now. But down the road at a much lower price level, we get another trigger for recovery. So here's some food for thought. If you, one way you can approach this is a martingaling approach. Okay, and martingaling, basically what you're doing is you're increasing position sizes after you take a loss, basically. Now, as long as you do this in a controlled way, martingaling works, and it works in a really cool way. So let me just give you a quickie example on this. We can go and take a look at the Facebook example then. So let's say that in the first position here, the first attempt at the bounce, this does not hold and it runs down and hits the stop. But 3 weeks from now or a month from now, there is another trigger day at a much lower price. You can go in, you're getting it at a lower price now, and you can go in and you can take a bigger position. You can like double the position like the first time. If that doesn't hold, right, we're going to assume that we'll get another recovery attempt down the road. It could be 2 months from now. You go in and you take a bigger position still, right? So what you're doing is you're basically kind of hedging on the fact that at some point you will catch this sucker and you're going to catch the recovery, right? And so by martingaling, using a martingaling approach, you help make up the previous stops. You follow me? Now, that being said, you can't martingale forever. And so what you don't want to do is say, okay, well, the first time I'm going to buy 100 shares, then I'm going to buy 200, then I'm going to buy 400, then I'm going to buy 800. Then you can quickly, totally outstrip your capital resources for trading, right? Doing that. So the first thing that keep in mind is there's a limit to how many times you can martingale. So anywhere you want to compute things out to anywhere between like 3 and 5 attempts. Okay, I would bet that if we played every one of these in the list going forward for the rest of the year, that somewhere between 3 and 5 attempts, you're going to catch the big recovery. I mean, wouldn't you say those are pretty good odds, Bill?
Yeah, I'd be shocked, quite honestly, if it was over three. you
Yeah.
know.
So maybe 3 times the charm. So what you can do is instead, you don't have to double the size every single time because again, you could quickly, you know, totally outstrip, Warren Buffett's account size, doing that. But what you could do is you could say, okay, first position 100 shares, second position 200 shares, third position 300. So in other words, each time you play it, you just add another of the same size of the beginning position. Does
Would
that make
it
sense?
would it kind of make sense to start with a small position on the very first attempt, though?
Well, there you go. And then that keeps the fear level down, and that keeps the emotions down about whether you're going to hook the perfect,
Yeah, I mean,
bottom,
here's the
right?
thing: is with commissions being zero, and some of these stocks are expensive and some of them aren't. But with something like $147 stock, I mean, 5 or 10 shares is not a big deal. Although I suppose you'd want to keep it in increments where you can actually scale out at the targets and then maybe even hold on to some, right?
Yeah, yeah. So one methodology is this martingale approach. If you follow this, and I'm going to work up like a little matrix and some slides, and we'll revisit this and talk about it in more detail. But in your mind's eye, you've got a list of stocks. Um, they're going to trigger when they trigger. If you just take the positions on each one of them when they trigger and you start off with your smallest position size, then you don't have to worry emotionally whether they start to recover or they don't if they hit the stop, because you're going to have another try down the road and you just increase the size. So the best way to approach this is pick a small starting position size, um, and work with the capital size. So maybe your first position is, let's just give you an example here. Uh, your first position on Microsoft, if you went in, uh, let's say that you take $1,000 of your capital and um, put it towards your very first Microsoft position, that's going to let you buy like maybe 30 shares right here, right? You follow me?
Hmm.
So if that gets stopped out, the next second position on the second try on Microsoft would be $2,000, right? Depending on where so, stick with a fixed amount of capital, and then just uh, add that in each play. So then your third play on Microsoft, if you need it, would be $3,000 of capital, right? You're not going to double it each time. You're just going to add back in the original amount. Does that make sense?
Hmm.
So that way you don't go, exponentially into the stratosphere trying to double every time, which nobody can do. Uh, and But it allows you to continue to play bigger positions, and this is just going to work statistically. Eventually, um, some of the stocks are going to trigger and work the very first try, and some of them are going to take 3 tries or 4 tries to start the recovery, right? So this is one methodology. You can play it without emotion, and it's very strategic, very statistical, and you'll be able to get your capital in these recovery vehicles and not fear about it, right? Now, there's one other way to play it, and I'll just tell you real briefly. The other methodology is to take extremely small positions, right? And maybe drop it way down. Uh, like with Microsoft, you could start off with 10 shares. And instead of trying to lump sum and hold it for the targets, what you're going to do is you're going to accumulate into the targets. So you could set up a little dollar cost averaging deal where every month, as long as Microsoft is still above that stop level, you just buy another 10 shares, right? You dollar cost average in over the series. And there's 2 ways to do that. You could pick a date that you want to do that. Like, you circle on the calendar and that's the day you just buy. Or you could look for something where, uh, in the next month, as long as you're over that initial stop level, and you want to be above your first entry point, right? That's another little key thing. You might want to only take entries higher than your first entry. Then you could wait for like a couple down days where you get a close below the 5 period moving average. So but you're doing is you're going to average in, but you're wanting to try to average in at lower valuations. Okay, that's another approach. So you can start off extremely small, and now doing so with the second methodology, the accumulation, if you only take a new position higher than your most recent entry, what that means is only the symbols that are recovering suck the money in.
Mhm.
That makes sense, Bill?
Mhm.
So that's another way to play this. So those are the two methodologies to play uh, this this
Yeah, and
list.
by the way, we're gonna build up some really nice documentation for this page. Let's talk for a minute about how the actual table itself looks and works here, because I'm sure that several people are gonna look at this and have questions about knowing when to buy and the fact there's no
Sure.
trigger, and so basically, what you see here is that some of these stocks, the stocks at the top of the list, have a stop loss in the targets, and the rest are all zeros, right? So, do you want to explain how to navigate this table and what to look for?
Sure. First off, the list is we want to keep this real simple and straightforward, so we don't want to have lots of different tables and open and close and this and that. And this is kind of a do-it-yourself list, and as I just described, there's multiple ways to play off of these. So we're not going to provide, this is the exact day of the entry, and this is the, exact place you want to move your stop to, and this and that. We might be able to enhance this a little bit, but we want to keep the concept real simple. And all you're going to do when you scroll back up to the top there, Bill, what you're going to do is you're going to see that when you look at this list, you always want to just check the dates on the left up there at the top. And if you see, like if you're checking at the night of the update and you see a stock with the trigger date of today, that's a stock that just triggered today, right? And you'll see the stop and you'll see the two targets. If you're checking the next morning, you'll see yesterday's date, and then you'll know that that stock triggered the day before, and then that's a stock that is in play, and basically you can uh, you know attempt to take your entries as you see fit, as long as you're above the stop price, right? And so uh, as soon as a stock triggers, it's going to just stay at that point, at that position in the table. So uh,
Well, so let's take a look at, say, Facebook, which has yesterday's date, and so would be actually triggering today, right? And so let's just look at this and talk about like how you might position your entry or whatever. I heard you say something about over the high of the day that it triggers,
mhm,
right? Might make for a decent entry, or
exactly. Go ahead and put in where this suggested stop
yeah,
is going to
I'll
go.
do that while you kind of talk about this a little bit.
Yeah. So again, um, if you're going to do proper money management and you're not going to bet the farm on these entries, right? Or you're not going to bet the farm on any one of these trading vehicles, then you can take the approach where you don't have to sweat the entry. In other words, you could have just bought at the open today, right? Let the chips fall where the chips fall. Um, Again, you're going to get some. In this example, you can see maybe when you zoom in a little bit, you can see how we actually opened lower than yesterday's close, right? So if you bought at today's open, you got a little bit of a lower price than yesterday's close, right? Uh, and then some examples might gap above where the stock was trading yesterday, and so you'd get a worse fill. But again, over the series, some are going to be good fills, some are going to be bad fills. They end up averaging things out. When you look at the big picture and you pencil everything out and you model your capital and how it's got into the market and it all gets averaged out, then these rough edges kind of smooth themselves out, right? And so that's one way to approach it. The other way is to be a little bit more critical about your entries. So this is a good example where you could say, okay, um, I'm going to uh, wait for a close above the trigger day, right? So you could be looking at this and say, "Oh, nope, we're not we're not a, we're not trading above yesterday's high, and we're not. It doesn't look like we're going to close above yesterday's high." So you'd go on hold. And a real simple thing to do, Bill, is if you're going to play off the highs like this, let's say that Facebook trades back down towards the stop. Let's say it even goes down and touches the stop, right?
Okay.
But you're not in it yet. Okay. You can just follow the highs down of every day that goes lower. Every day that the high, you have a new lower high, that is your new trigger line. That follow?
Hmm.
So one scenario, we could run all the way down. Let's say you're not in at this point. You run all the way down and you either get just above the stop level or even tag it, but then we end up with maybe a narrow range day down in there, and then uh, you can trigger off of those highs. So we got a little bit of leeway here. Again, this first bounce could be really sloppy. It's already looking sloppy, right? Because the ranges are so extreme and
Yeah, yeah. This is pretty interesting concept. I just wanted to put that trend line on there because I was seeing it with my eyes. We got kind of a
sure.
trend line break, and interestingly enough, the stop on this looks like it's just a couple of bars back instead of the actual low of the pattern. So that's kind of interesting. But yeah, a lot of these stocks look like the type of. Let me ask you another question real quick.
Uh-huh.
I noticed that we have all the indexes on here, or the ETFs for the indexes, the Qs and the Dow and the Russell and that. So it would seem to me that if you were going to play one of the indexes, that you probably be better off just picking one of them, right? And also
Sure.
there's obviously there's going to be some picking and choosing of the stocks on the list because at some point, a lot of these things could trigger in and people only have so much limited capital. And so that's, going to be a little part of it too is, kind of going through the list and maybe looking at the charts and deciding which ones look really good and sort of maybe focusing in on those, right? There's a couple on here that appeal to me a little more than others, and so that's going to be a little part of it. But like you said, looking out 3 months, 6 months, a year, these are the type of stocks that some of these are really going to have good recoveries and probably never look back. And in the event that we do get another big leg down in the market, it's still not going to change the fact that these companies are going to be around for the long haul. And you've got the indexes in here too.
Sure. The list is comprised to give us lots of things to work with and to basically appeal to different folks. There's going to be people that um, are salivating over trying to get back into Apple, right? Because they're just Apple fanatics. They love Apple. They want to buy it, at lower prices. So we have Apple on the list. There's other people that want to play this potential recovery in crude oil, right? So we have the DBO ETF in there. Uh, there is, we even got one, you might want to show it. It's reverse volatility. It's short the VIX. Okay, that's going to be a nice play also as the markets settle down. So here's the one for oil. Uh, who thinks that oil can stay down at these low valuations forever and ever? Maybe oil can go lower and it can stay down here for 6 months, but we know it's eventually got to recover, right? Just because of, the oil industry cannot sustain itself with oil at these low price levels.
Yeah,
Okay.
interestingly enough, the DBO, which I pulled back up here, is that's a cheapie. It's $6, right?
Yeah, and so we're going to have you're going to have all price levels in here. The price of the price of the vehicle is not so important because, again, work with fixed capital amounts, right?
Hmm.
Break your account up. If let's say you got 10K, break it up into, you know, uh, buckets of $500 of capital each. So you got 20 little buckets then to start, using in this recovery concept. Um, so you got to do a little bit of homework and try to figure out how much capital that you want to put to work. Now, as far as diversifying goes, yeah, it's good to diversify because something like one of the individual companies could have some kind of news related, price shock on top of all the market mayhem we've had, right? And we could end up with a big gap down on an individual stock. So a lot of things can get in there and affect this. So again, that's why you don't want to bet the farm on one vehicle. Now, that being said, you don't want to over diversify either. So diversification that's a double-edged sword. Diversifying helps to prevent against a single price shock, right? A single uh, uh, drastic, drawdown. Uh, However, if you over diversify, you just end up with mediocre results. So then, what's the magic number? Anywhere between I usually say 3 to 8 um, trading vehicles, right? I mean, you could go to 10 if you absolutely wanted to, but any more than that, you're gonna marginalize your returns by over diversifying. There is no sense in having 20 stock positions or 37 stock. It doesn't make any sense whatsoever. I see people do stuff like that. Keep it lean, keep it mean. Um, so yeah, let's say that you had a smaller account size and you said, okay, I gotta be a little bit lean here on my picks. I'm gonna try 3 different plays. So you could say, okay, I like the oil play. I like the reverse, short the VIX play because I'm, almost positive things will settle down. And I love Microsoft, so I'm gonna try to play those 3. And you just ignore the rest. Then you just pick those 3 entities, and you wait for the triggers. You just put your capital into those.
Yeah, it's important to realize like some of the ones that I pulled up on the charts there and looked at are not triggering in yet. I just like the DBO and the SVXY and a couple of the other ones I pulled up there real quick are they're not triggering in, and so until you actually see the stop show up and the date on the table, they're just potentials, right? And so, it's not. We're getting a little bit of a rebound here, and so just casually looking through some of these symbols, it's not going to surprise me to see more of them triggering in tomorrow. So that's kind of
Oh
a
yeah, yeah. Well, and again, halfway expect that this first bounce is going to be extremely sloppy. It's already starting out very sloppy because we have a real whipsawed market by the news right now, and that's just you just have to understand how much the news can have. The news is what uh, ignited and was the main catalyst of this huge sell-off, right? The constant news. Obviously the reality of what's happening too, but the news gets in there and really affects things. So uh, this first this first bounce attempt could be real sloppy, and it might not even hold. The other thing is that we may add additional uh, symbols, trading vehicles into the recovery list. And by the way, if you're listening to the show and you have your favorite stock or what you think would make a good recovery, send us the symbol and we'll take a look at it and see if it can go on the list. A recovery candidate has to be a stock that is not going to go bankrupt. In other words, it's a stalwart type of uh, an entity that's going to be around, and also it has to have had an extremely severe sell-off. Those two things make it a recovery play.
Yeah, I just thought of a new potential one myself. Procter and Gamble might not make for a
Let's
bad.
let's put that. Let's
Yeah, I
pull
just
that chart up and see what it looks
pull
like.
up the chart here and see what it looks like.
Oh yeah,
Yeah, pretty good sell off there.
all right. We'll add that
And
to the list.
yeah, and so I think that yeah, there's potential to add some more stuff. And of course, you could play the indexes very easily with it too. But I think that there's kind of a happy medium between playing the indexes and getting some good bang for your buck with these individual stocks, right?
Yeah, the stocks typically individual stocks can give you a lot higher octane returns than the general market. However, they come with increased volatility and the fact that we could experience overnight gap downs due to news on that individual stock, right? So it's a uh, always a double-edged sword with stuff in the market, making decisions in the market. But uh, yeah, this list, I think, and we actually had this idea to add this list a while back, and so this is actually perfect timing. The fact that we're talking about it, we just put the list up, and we're talking about we already got some of them triggering just yesterday, right? So perfect timing.
This Exxon Mobil is incredible. I mean, this has been, with the sell off in oil and that, just absolutely amazing to see. Just this literally this time last year, this thing was trading around $80 and dropped to 30. And so,
Yeah, so like just think about this. This one hit a double whammy. Not only did the market drag this down, but the collapse of oil drug the price down too. So, perfect example of a good recovery stock. Um, here's what I want you to do. Uh, do me a little drawing here because this is going to really show people how this kind of plays out. Give me stay pulled out way out like you were on that XOM. Give me a horizontal downward sloping resistance line above the highs. Now
right.
I'm talking about the long-term highs before the drop.
Yeah.
Okay, not the current highs. Okay, so it's just starting way up there. There you go. Now give me one from the lows all the way back in that far left there. You got that big pivot low, and run it up under the lows right before the collapse. Okay, you're gonna end up with a big like wedge, but I want to like show something here.
All
All
right.
right, beautiful. Now that's the bed. All right, and so this is like good old-fashioned Wall Street stuff from 100 years ago. This stock has fallen out of bed, hit its head on the floor. So what it's going to do, it's going to attempt to climb back into bed. That's the old Wall Street, uh, technical analysis for dummies, 100 years ago. So this is going to attempt to crawl back into bed. And so this is where we get the retrace from. Um, Even if it can't climb back into bed and it can't resume its uptrend, right? Or, back up above those support levels, it's going to make an attempt. So you can do the math on that. You can see that. What are we trading at? What is that? $35 a.
36, yeah.
All right, so 36, and let's say that we trace like halfway back up there to, let's say about like $56, right? Um, that is a 50% gain, right?
Mm-hmm.
So the point is that these recovery plays can be powerful vehicles for some gains going into the future. Again, the trick is we got to know when when the proper buy points are.
Well, and of
And
course, and real quick, I just want to mention this one is not triggered in. It's just on the list. And so,
right,
this would
it's
be a
not
good
triggered
one to
yet.
keep your eye on for when it actually does trigger in.
Exactly. And so if you go into this, uh, keep your initial positions very small. In other words, keep plenty of ammo in reserves, uh, and assume that you got 50-50 odds that your first entries are not going to hold. So you're going to have a second attempt out in the future. And as long as you can take a slightly bigger position the second try, the third try, you're eventually going to hit it, right? You're eventually going to trigger in, and then you just make up your stop outs. If you approach it like this, you have like almost a guaranteed system for gains over the next 3 to 6 months. All right.
Yeah.
As long as you keep pulling the trigger and keep playing these. Where people get into trouble is like kids in a candy store. They're like, "Oh, all these prices are beaten down. I'm going to jump in, right?" And they jump in way too early. I mean, there were people like trying to jump in stocks 2 weeks ago.
Sure.
All right. I mean, uh,
Half the
so
people that I see, on CNBC, like you said, 2 weeks ago, when the market, had like, was down like 5%, 7%, they were already saying, oh, it's a great opportunity to buy the dip.
yeah, obviously not, right? Yeah. So we need the proper technical triggers, and that's what this algo is specialized in being able to try to pick off the bottoms after a big drop. So there you go.
Very cool. So, okay, well, let's wrap this up, and I just wanted to let everybody know that forthcoming is going to be some really good documentation and explanations of what we talked about, and we will add that below the table, which we just basically put up last night. And so, yeah, and by the end of the weekend, maybe into next week, you'll have some really good sort of explanation on how to play everything. And of course, we can come back and discuss it further after that, and sort of take it from there. So, this is a really neat sort of addition, and it's the perfect time to introduce this. I know we've talked about it for a while, so why don't we leave it here, and we'll let people just sort of go over some of the stuff that we'll introduce onto that page there, and that'll come kind of slowly and a little bit here and there. And so by this time next week, we should have some pretty good background and documentation below that table, and then we'll come back and look at some of the stocks next week. What do you think?
So, yeah, sounds great.
Okay, well, hey, thanks a lot, Jeffrey, for coming on the show this week. And this show will also be available for replay for the rest of the week. So, everybody stay safe out there, and we will see you back here next week. See ya.
Very good. Talk to you.